Hi, welcome back to the channel. Now, before I get into the charts and the outlook for June, and of course walk you through all of the data that you all tune in for, it's continued to be a wild few weeks. There's been a lot of chop. It's been a bit of a roller coaster, which has resolved ultimately to the upside for the markets. And of course, I hope my work over the last few months has continued to help you in some way. There's been a lot of big moves in a lot of the beaten up areas recently, as well as the flight to safety in mega cap tech, which is of course set against a backdrop of a lot of negative news and a lot of economic turmoil. But this month I will walk through a high level broader market analysis with quite a few stocks and ETFs that you can add to your watch lists for the month of June. You'll probably find a lot of value from my work, and hopefully the Scottish accent isn't too tough to understand. Now, everyone's asking if the market has already bottomed, or is the big economic collapse that everybody's expecting just around the corner. On one hand, you've got all of the perma bears screaming that it's just a matter of time, and on the other hand, we've got a lot of the perma bulls screaming that the market bottomed in October. Now, just for complete openness, I'm neither a perma bull or a perma bear. I'm very open to all outcomes, as 90% of you watching this will already know. I analyse the data as it comes in, and I'm open to changing my stance on 30 seconds notice. But managing risk is always priority number one. Now, investor sentiment is showing that there's a little bit of greed out there. Now, for disclosure, with some of the charts and some of the names that I will be covering this week, myself or our clients may already hold some positions in those names, but I have highlighted those disclosures on the charts. If you are new to my channel, I like to use a combination of technicals and fundamentals. I'm told that I'm very, very good at removing a lot of confirmation bias from my charts. As most of you know, I do not use the magical hindsight indicator. I timestamp all of my work, which is incredibly important. I'm not a short-term day trader looking for little tiny 20-cent moves. I'm looking for structural trends that will last weeks to months, primarily trend following with elements of swing trading. And my work is really for everyone, everyday investors, traders, financial advisors, money managers, options traders. I'm told my work is among the very best in the business, so hopefully it all makes sense. I am very well known in the professional community for my ability to highlight the big risk on, risk off turning points at the right time. I'm not one of those analysts that make broad market calls before they eventually play out 6, 12, 24 months later. Very few go on the record with their work. I'm one of them. But to give myself a little bit of credibility, if you've just stumbled across my work, some of our big time-stamped calls, we could go back to the market crash 1 year ago, the bear market rally last June, the exact top in August, the market bottom in October, which was a big one, the rotation back into tech this year, and of course you could go all the way back to the crash of 2020 as well. So I do have a track record of being mostly correct, which obviously helps in this field. So if you find value from my work, please do like, share and subscribe on YouTube, and feel free to share on Twitter. But please pause the video, make sure you're comfortable with that very important disclaimer before watching any further, and let's get into the charts. Now, before I get into the charts, we have just recently partnered with TradingView. They are perfect, the biggest technical analysis platform on the planet. They are very, very cost effective, and there is a link in the description for a free 30-day trial. Now, I will start off just by quickly touching on the S&P 500, but I will step it back a little bit to give a little bit more context around this. Now, the S&P 500, which I'm using the ETF SPY here, has broken out above its Fibonacci retracement levels, a confluence of resistance levels that I think most of us professional analysts have been watching with a lot of interest over the last few months. We have resolved to the upside, however, we have resolved to the upside on deteriorating breadth. Now, the breadth indicator that I'm using here is the percentage of stocks trading above their 200-day simple moving average. Now, if you look at the numbers from the month of May, what you'll notice is the big tech charge led the market higher because the triple Qs were up 7% last month, whereas the NYSE composite, which is a good reflection of the total US market, was down around 4% on the month. So there has been this discrepancy in the performance of certain areas of the market. And I think what most of us professionals want to see is some kind of participation from a lot of the areas of the market that have been beaten up over the last few months. But to give a little bit more context around this, I want to go back to a couple of economic indicators, and I just want to touch on the yield curve. Now, I like to touch on the yield curve every month just to see where we are. We can see that during the month of May, we have had a deterioration in the yield curve. Now, the shaded areas on this chart represent recessionary periods for the US economy. Now, as we can see, we haven't come out of the yield curve, and we've been told that we're not in a recession. Now, I don't know about you, but it certainly feels like a bit of a recession to me. But what I want to do is just take the data back a little bit here, because I first presented this chart a couple of months ago and I got a little bit of pushback on it, because I think most of us already know that we've been told our whole lives that 2 negative months of real GDP equals a recession, and we had 2 negative quarters of GDP last year, but for whatever reason that was not classed as a recession because the goalposts suddenly shifted. Now, I don't know about you, but that seems like it's a little bit of shenanigans to me. Now, I've actually done a little bit extra work on this, and what I did here is overlaid recessionary periods in the S&P 500, which is the shaded areas, and calculated when we entered the recession what the average decline in the S&P 500 was. And we can see, broadly speaking, you're anywhere between 15 and 35% on average. Now, if we had included the 2 negative quarters of GDP as a recession, as it should have been, that would have equated to an S&P decline of 21%, which is in line with the previous declines in the S&P 500. So for the last 9 months, I've been working on the assumption that we could well be in a period where buying stocks becomes sensible. Ultimately, hindsight has shown that's been the correct way to look at things. But of course, we don't look to the past, we're looking forward now, and what can we expect in June? Well, we have the S&P 500, as I said before, breaking out, but to give confidence in this breakout, I would want to see the percentage of stocks above their 200-day simple moving average start to expand, get an expansion of breadth here. But to the other side of things, I am very, very mindful of these charts as well. Now, all I've done here with this chart for the S&P 500 is overlaid Fibonacci extension levels from the dot-com bubble down to the financial crisis. And as you can see, this chart has had a lot of merit over the period. The sideways market from 2014, 2016, the 2018 correction. Of course, we put in a failed breakout, which was a big part of my thesis with the COVID crash. And then we put in another failed breakout right at the start of last year. And we had, again, another crash. But, of course, on the path higher, we need to see these levels overcome. So I have my eyes on this 44.20 level to see whether or not we can get back up above these Fibonacci levels. This is a level that I've already communicated to our clients and members in the month of May, with the caveat that, of course, we've got big moves in the triple Qs, with the big tech leading the charge, hitting new 13-month highs. But what I would say is, as I record this, there is still around 2 hours left in the market on Friday. So these charts are open to a little bit of change, but we can see that the small caps are attempting to break out as well. And I actually think the one chart snapshot of the market shows things really clearly. I think if you have a bearish outlook and you're determined to short stocks, which I understand makes sense for a lot of areas of the market, but what you're likely to see is, if there is substantial follow through on the small caps, for example, which is a very good indicator, a chart for market risk appetite. If we see the small caps rip higher from here, that's going to be very difficult on short positions. We've got the triple Qs making new 13-month highs, the S&P 500 breaking out. I'm not seeing a lot of bearishness when I look at the major indexes for the US markets. But it's not just the US markets. Today, it looks like the All Country World Index is putting in a breakout here to new 12-month highs. Now, I have overlaid the S&P 500 chart with the All Country World Index, and as you can see, there is a very strong correlation. So if this chart breaks out to the upside, again, that's another bullish catalyst for stocks. I've been talking about these charts for months now, and I feel like a lot of the bearish sentiment folks are now starting to come around, and you know, the pain to the downside can only last so long before, you know, bearish positions ultimately just get caved in, and then of course spurring the market to newer highs. And that's something that I'm looking for across the global markets. We already know that tech has broken out on both an absolute basis and a relative basis. Hopefully, again, my work over the last few months across social media, across Twitter, has helped you in some way. We have seen some massive moves. We've got the communications sector breaking out to new 11-month highs. We've got the US dollar index, which is currently range bound at the moment. But the US dollar is very important to my work because of the inverse correlation with the S&P 500. So I am looking at the dollar chart, and I would like to see the US dollar perhaps reach 105.50 and then start to fall away, which I think could be a potential bullish catalyst for stocks across the board. But as I said, the inverse correlation is pretty clear, and I think the one chart there really shows that. Since the 14th of April, which is the date the US dollar index put in its near-term bottom, as we can see, that has been bullish for really only tech. The rest of the market has struggled. We can see it's been incredibly bearish for the commodity index. So, you know, across the board, if you look at energy for oil, you know, we've got gold, we've got TLT, the bond ETF. A lot of these have been taking a hit because of a rising dollar. But financials continue to hold up despite all the negativity with all the small regional banks. For me, the regional banks put in a capitulation on the 5th of May. Again, highlighting disclosures. We've already communicated this to our clients on the 5th of May. But we are now breaking above the 50-day simple moving average. Like I said before, I like systematic process that removes a lot of noise from the markets. And we've got the micro caps, which are now, they've been holding on for dear life over the last 3-4 months, but it does look like they could be catching some kind of meaningful bid today. And of course, we have XLK, which is just moving through the target levels like a knife through butter at the moment. We met our upside objective here in XLK. We hit target 2, and that now brings in target 3 around 177. Growth versus value gets a lot of debate. For me, it's a non-debate at the moment. We're hitting new, fresh 9-month highs in the growth versus value ratio. So what this chart tells me is I want to be looking for growth stocks, not value stocks at the moment. But of course, there's the massive moves in semiconductors, which I will be getting onto in just a second. But semiconductor ETF SMH, we have an upside objective here around 156, and of course we've got the semis relative to the S&P 500 looking like it's trying to break out of a 23-year base. Now, if you are a money manager and you're looking for outperformance, these are the types of charts that you're obviously looking for, because you want to outperform the S&P 500, beat the benchmarks that a lot of clients obviously set. But the big question with semiconductors is this breakout going to hold? Now, I am about to walk through around 20 individual stocks and ETFs that I think you can add to your watch lists. But if you're still here, please do hit the like button. It's the only thing I ask. We've got the markets putting in big breakouts at the moment, and hopefully you're finding a lot of value from my work. But again, I want to touch on Nvidia, because Nvidia has been the biggest mover this year. It has been on a rocket ship. I have been covering this since the start of the year. But for disclosure, although we obviously put this to our clients on the 3rd of January, this week I have actually disclosed to our clients and members that my own personal position has exited. I'm very happy with the numbers that Nvidia has done. Have I sold too early? I think there's a possibility that I have. But for me, thank you very much, Mr. Nvidia. I'm moving on. I'm already looking for different opportunities. But the reason I sold was just purely because of the moves. Then we got this candle here with a downside follow through. I've sold here in this candle, and ultimately I'm waiting to see what comes next. Are we going to get a big pullback, or is it going to continue on a rocket ship? Well, with Nvidia, this is the chart that our clients are working with at the moment. There is a confluence of potential target levels here using Fibonacci. Extension levels from the 2018 declines and also the 2021 declines. So if you are out there and you are still holding Nvidia, I think it's quite logical to aim for that $490, $500 level as a potential upside target. But I would be very mindful and have some kind of systematic process that will keep you in a position. And for me, if it starts to break down below these levels and looks like it wants to fill this gap, then that's a big problem. But I think for the moment, I think you can still remain bullish on Nvidia, but with definitely a one eye on risk management given the moves that it's had. Amazon, I've been covering this one for quite some time. Congratulations, everybody. We are still working with upside objectives here around 145. I am noting that our systematic stop is now up at 116. I will be communicating that to our clients this weekend, but there is still a bit of upside follow through there on Amazon. Google, again, looks like it's breaking out above key levels. We are working with an upside target there of around 150. AMD, again, going back to the semiconductors, what's going to happen to semiconductors when SMH hits that 156 level? I, of course, don't have the answer to that. But what I do understand is that, certain technical tools like RSI help us to understand when stocks are perhaps a little bit overbought or a little bit oversold. I think it's been quite reasonable to expect a pullback in AMD. The pullback hasn't been as deep as I perhaps expected it might be, but I think it looks like this level here with this gap is currently holding up at the moment. But I think any weakness in AMD will probably offer opportunity. I think it's one of those that can absolutely keep going. I think you can remain bullish on this above 105. Now, I'm covering Micron Technology because I covered this one a few weeks ago, and it ultimately met upside targets here around $75. But we have put this to our clients as well. Last week, advocated exiting at target 1 with stocks and options. So for me, the chart is now probably a little bit more messy than I would like it to be. It becomes appealing if it can pull back to this kind of 65 level or break out above $75. Those are the two levels that I would be watching for potential new entries into Micron. We've got Apple. We're looking at this now for a potential further position breakout above 184. It has met our upside objectives. I think if you follow technical analysis, all-time highs becomes a very, very logical target level. So we've actually put it to our clients this week that targets have been met in Apple. Let's see what happens next. Will it break out above 184? Of course, it's a great company, great long-term investment, etc., etc. But technically, it needs to break out to new all-time highs, and we like it above 184 or a deep pullback. MasterCard, again, one of the mega cap blue chips. We like it above 400. It has been basing now for a couple of years. This is on my closely followed list, so I am watching this with a lot of interest, potentially above $400. Microsoft, again, is approaching our upside targets there around 350. Very, very similar to Apple. Just want to hit the targets and then potentially look at it on a deep pullback or a further breakout. Very, very similar with Tesla. Tesla's hit logical target levels for us, but we are looking at this to potentially break out here. I think if it can break out again above this 220 level, I think it brings in target 2, which is around 320. Now, I will say that I am not one of those Tesla fanboys. I simply just observe the chart. I absolutely love Elon Musk. I love what he's doing. But for me, Tesla is one of those that can pull back quite sharply when it decides to. But again, above 220, I think there's a massive upside target to aim for there. Berkshire Hathaway, I covered this one last week. Congrats anyone who does anything with range bound charts. They're so easy to play. You just buy at the bottom, sell at the top. So it is approaching that 330 level, but again, looks like a potential double bottom to me. So if that can break out above 335, then again, I think Berkshire Hathaway could be off and running. We've got Palantir, which, look, it's been a ridiculous mover. What I would say with something like Palantir, and I have been covering this on my social media channels for quite a few weeks now, I have been asked about it, and for me, when a stock moves 60-70% in a matter of weeks, it becomes very, very difficult to justify moving in on brand new positions. This is where I think, optimal entries and of course technical analysis does help a lot of folks. It's just saying that, if you're, perhaps got an investing mindset and you're really not into technical analysis, but you want to maybe buy a stock. I think what technical analysis really helps is really just understand where optimal buy positions are. And for me, although it could break out above this level here, again, it's probably a little bit overextended, but Palantir has been working very, very well for a lot of our clients and members since the 14th of May. But ultimately, it's become a risk management game. We've got Meta again, same story. It's just been on an absolute rocket ship. If you look left on the chart here, just to show you what I mean, why this has become a logical target level for us, is really just filling the gap from the January 22 levels. But Meta continues to resolve itself higher, and if you're in there and you've been holding Meta since the start of the year, like many of us, then congratulations. But I think that January 22 gap probably becomes a logical pause level. And again, Spotify been doing very, very well. It is approaching upside targets here. Now, some ETFs that I think you could potentially look at. Now, my work over the last few weeks has had a bit of attention because I've made some bearish calls on China. Now, I'm only bearish on certain areas of the market for as long as the charts tell me that the charts are still bearish. But something I understand very, very well is the potential for failed moves. And some of you might know the slingshot effect, where you get a failed breakdown and then it breaks up above the breakdown level and then it just rips higher. We call this in the technical world a failed move with a fast move going in the opposite direction. I don't know why it happens like that. I think it's probably just shorts just being caught out, bear trap, whatever you want to call it. But I think if these two charts resolve to the upside, and I will be communicating this chart to our clients this weekend, I think if China can break back up above these levels, then Alibaba probably comes into play, Pinduoduo. You'd probably want to see KWeb do the same thing. So I will be watching the Chinese stocks with a lot of interest early next week to see what happens with these charts. We've got gold, continues to be range bound. It's not appealing in any way, shape or form for me at the moment. And of course, we've got the AI ETF, BOTZ. Next breakout level is above $29. And of course, we've got MDB, which has been a massive gainer over the last couple of weeks. I did post this chart to social media today. That's why I've included it at the end of this analysis. But I think with something like MDB, because it's made such a massive move in the last few weeks, the last thing you want to do is give up massive gains. Again, I will be communicating this to our clients this weekend, that we have reached a massively overbought condition. RSI, I think, got as high as 87 intraday today, and we are starting to see a little bit of a pullback. But again, risk management, systematic process would take anybody out at 324 anyway, so it's obviously been a really, really healthy gainer. So I hope you've found value from my analysis. If you are new to my work and you're perhaps interested in what we do at honeystocks.com, we provide full access to all of our memberships, which provide access to all of our premium weekend analysis, all of our best charts and all of our best work. We provide access to all of our high conviction trade ideas, which I will show you what that looks like in just a few moments. Access to our midweek halftime report. Provide access to a wonderful community. All of our chart books are included with our memberships as well. So all of our ETFs from all the individual sectors and the ETFs from around the world, and all of our commodities and stocks chart books. If you need a chart, we also have a chart request where you can request my charts at any time. And if you are somebody that's perhaps quite new to technical analysis and building systematic processes, etc., I'm told that I've built one of the very best technical analysis system building programs there is. Very, very professional setup that I have. You can check it out on this website. But just to quickly show you what our high conviction ideas look like, this is a recent alert that went out for Tesla, which I did just cover a few moments ago. Very, very clear instructions, very easy to understand chart, and of course logical targets. Tesla at the start of the year, which was a 90% gainer, which is a play on capitulation. Meta, I touched on that chart again, above 125, and the chart has just been running ever since. Amazon, again, this is up at 125 at the moment, doing incredibly well. And we've got, of course, Apple as well, which has just hit upside targets. But I am very unique in what I do. I have a very much a quality over quantity approach to my work. It's the reason it works. I'm not somebody that's spamming your email inbox with 10 alerts a day. One, sometimes two high conviction ideas a week, and that's why it works. So feel free to go onto our website. It's all logged for complete transparency. There's not any penny stocks. I think my work is a good fit for anybody that likes to buy good quality stocks. I think if you have a mid-term approach, if you are looking to perhaps get away from day trading because you find it too stressful, if you're looking to build a systematic process, or just, if you're too busy with work, life, family, business, whatever your deal is, my work might be a good fit. It's a community that I would say is really built upon a lot of intelligence as well. There's a lot of professionals, got money managers, doctors, lawyers, etc. So I think if you want to be part of a community with like-minded folks, then my work might be a good fit. And if you want to have access to me on a daily basis, again, that's included with all of our memberships as well. So feel free to go and check out our website. But if you are still here, thank you very much for watching, and I hope to welcome you soon. Thanks as always.